Please read the problem. City Limited purchased a high-tech machinery as on 1st April 2006 for rupees 14.60 lakhs. The company incurred a non-refundable tax expenditure on this machinery for rupees 50,000. There was a trade discount to the extent of 1,50,000. The estimated life of the asset is 8 years. The expected salvage value at the end of the machine life is 3.5 lakhs. The company is following WDV method to write off its assets. During June 2008, the asset got revalued upward by 20%. City Limited got a loan of rupees 10 lakh at 12% per annum from a bank to purchase this machine. The loan sanctioned on 1st April 2006. The machinery was ready for use on 1st August 2006, but actually put to use only on 1st September 2006. After revaluation, the company is maintaining its existing depreciation rate to write off the asset. Required to show fixed assets account, depreciation account, and revaluation reserve account for the 8 years of life of the machine. See, seeing this problem, we have to find the following things. First, in this problem, the depreciation rate is not given, so that we have to find. The next thing is we have to find the cost which are to be added to the purchase price of the machine. To identify the cost of the machine, we have to look into the treatment of interest cost of the loan taken from the bank, non-refundable tax paid, and the discount we have got. Then we have to see how the revaluation is handled inside accounts. If we understand all these points, we can easily prepare the required fixed assets account, depreciation account, and revaluation reserve account. Now we have to do some workings. First working, the depreciation rate we have to find. For that purpose, we have to first calculate cost of machine. See, purchase cost they have given in the problem as 14,60,000, and we have to add the non-refundable tax paid by us, 50,000. Then the interest part which was paid to the bank till the machine was ready to use should be added to the cost of the machine. See, here 10 lakh rupees we have got as a loan, and the machine was ready to use as on July. So April to July, 4 months, we have to 4 months interest we have to add to the cost of the machine. But actually the machine put to use only on 1st September. That is 1 month, August 1 month, we have not used the machine. For that part, whatever interest is there, it should be transferred to profit and loss account. So the interest paid from the date of sanctioning of the loan to the machine was ready to use, that period 4 months, interest should be added to the cost. That is 40,000 we are having. How we have calculated? So 10 lakh into 4 divided by 12 into 12% we have applied, and we are having 40,000. So the total is 15,50,000. Then we have got 1,50,000 as a trade discount. that is being reduced. The cost of machine is 14 lakh. We are arriving. The next working what we have to do, we have to find the depreciation rate. The formula to find the depreciation rate is, because in the problem they are telling that they are going to apply return down value method. So the formula is 1 minus salvage value divided by asset value to the power 1 by n. N is equal to life of the asset, SV equal to salvage value, AV equal to asset value. Salvage value is 3,50,000. It's given in the problem. Now we have to fit the figures in the formula. So 1 minus 3.5 divided by 14 to the power 1 by 8. So now we can represent this as 1 minus root of 0.25. How we are arriving 0.25? 3.5 divided by 14. It's 0.25. The 1 by 8 is shifted to before the root. If you are using the scientific calculator, immediately we can find the answer. But in our examination, the usage of scientific calculator is not allowed. So we should know how to find this nth root using the ordinary calculator. For that we can apply these seven steps. The first step is, in the ordinary calculator, you please type 0.25, that is 3.5 divided by 14. So we are having 0.25. Then 12 times you have to press the root sign. 12 times you have to press this root sign. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Now we have got some figure. That figure I have given in this G column. What answer we are going to get each and every step I have given, that you can cross verify with that. Then from this second step answer, we have to reduce minus 1. Okay. Minus 1 was done. Then it is divided by 8. Okay. Then add 1. Okay. Then continuously we have to press int and equal to 12 times. Int equal to. So 12 times if we press, we are getting the answer as 0.84091795817. This figure is subtracted from 1 and multiplied by 100. We are getting 15.9082% as the interest rate. If we apply this rate in the WDV method, we will land at the end 3.5 as the salvage value balance at the end of the 8th year of the mission. I will show the verification for this rate. See the verification table. So 14 lakh I have taken as the cost. I am going to apply 15.9082 as a WDV depreciation. At the year end 8th, we are having 3,50,072. So if you round it up, it will be 3,50,000. This is equivalent to salvage value which we are going to get at the year end 8. Okay. So that rate 15.9082% is the correct rate for the WDV method. Now we will see the solution. See, in the problem they have asked fixed asset account. Fixed asset account, then depreciation account, then revaluation reserve account. 8 years we are going to prepare. First year in the fixed asset account, we are going to debit 14 lakh to bank. In the first year depreciation 31/3/2007, we have to calculate 15.91 percentage as the depreciation rate. Okay, are you able to understand? 14 lakh into 15.91 percentage. So the depreciation is coming around 2,22,740. We are having a balance carried over 11,77,260, and the next year it is being brought forward. Then again one more year depreciation you have to find. In the third year, that is in the month of June 2008, 20% revaluation of the asset is happening. Okay, so for this 9,89,958, we are going to find 20%, and it is getting added with the fixed asset account. For this total 11,87,950, we have to find the depreciation. See, so inclusive of the revaluation reserve account, you have to find the depreciation. So at the same time, during this third year, we have to open the revaluation reserve account, that we will see. So by fixed assets, revaluation reserve account is getting credited to the extent of 1,97,992. When we are calculating the depreciation, inclusive of this revalued figure 1,97,992, we have calculated depreciation. So this part, for this part, whatever depreciation we have calculated, that should be transferred to profit and loss account. See, 1,97,992 into 15.91 percentage. It's coming around 31,500. This amount will be transferred to profit and loss account. Then next year, again we have to calculate depreciation in the fixed asset account. The same way, for the balance brought forward revaluation reserve amount, we have to calculate the that portion of depreciation account that should be transferred to profit and loss account. The same way till 8th year we have to go. In the 8th year, how the treatment is there? Because the asset is becoming unusable, because the life of the asset is 8 years only. At the end of 8th year, see, 1 year full depreciation we have to charge. For the 4,99,482 brought forward figure, we are charging 15.91 percentage. Then we are getting 3,50,000 rupees as salvage value. Then the very, very important point is, when there is a loss at the time of selling the goods, or when the asset useful life is getting closed, whatever loss is there, that loss amount can be transferred to the revaluation reserve balance. So now at the year 8, the revaluation reserve account balance is only 70,002. So that much amount we can transfer from the fixed asset account to the revaluation reserve account. The balance loss 12 rupees, it is getting transferred to profit and loss account. So this is the main area. We have to be very clear on this. So 1 year at the end of the eighth year period, 1 year depreciation I have charged. Then I have got 3,50,000 as a salvage value. And there is a loss of 70,014. This 70,014 is segregated into two parts. At the end of 8th year, whatever revaluation reserve balance is there, that much we can reduce this loss. So this 70,002 amount is transferred to revaluation reserve account, and the balance 12 rupees is transferred to profit and loss account. We will see how the revaluation reserve at the reserve account is at the 8th year. The end of 8th year, we have transferred 13,245. That portion of depreciation amount for the balance brought forward from the 7th year, that is transferred to profit and loss account. The balance was 70,002. So this amount was adjusted for the loss of the fixed assets. Are you able to understand what I am telling? Okay. So the depreciation account is usual that you know how to do it. That I will show you. So 8 year depreciation account we are showing here. So once again I will show the solution from the beginning. You can take note of this. So fixed asset account, please take note down. Now we shall slightly recapture about the revaluation reserve treatment as per accounting schedule 10. If the revaluation in the upward direction is happening for the first time, then what we should do? We have to increase in net book value by way of crediting the revaluation reserve account and debiting the asset account. This is for the first time revaluation in the upward direction. For this, we have to debit the fixed assets and credit the revaluation reserve account. For the first time, if the revaluation is done in the downward direction, what shall we do? We have to transfer that loss, revaluation loss, to the profit and loss account. The entry is profit and loss account debit to the asset account. Okay. First time valuation we have done in the downward direction, and subsequently for the same asset the valuation is done in the upward direction. What shall we do? Decrease in the net book value is charged to profit and loss account in the year in which downward revaluation was done. Okay, first time whenever we are going to reduce the fixed asset value, what we have to do? Profit and loss account we have to debit, and we have to credit the asset account. So the value is getting reduced. When there is a upward direction of revaluation, at that time the amount of revaluation that can be credited to profit and loss account is restricted to the amount of devaluation earlier written off. Balance amount of revaluation should be credited to revaluation reserve account. One more scenario. First we have done a revaluation in the upward direction. Subsequently, for the same asset, there is a revaluation in the downward direction. What we should do? When there is a upward direction, increase in the net book value is credited to revaluation reserve account. Okay. Then the amount of devaluation, that is downward direction revaluation, what we should do? The amount of devaluation can be charged to revaluation reserve account to the extent the revaluation reserve earlier credited is unutilized. The balance amount of devaluation is charged to profit and loss account. Are you able to understand? The amount of devaluation can be charged to revaluation reserve account to the extent the revaluation reserve earlier credited is unutilized. The balance amount of devaluation is charged to profit and loss account. So when there is a first time when we did upward direction, what we would have done? Fixed asset account we would have debited, and the credit we would have given to revaluation reserve account. For the same asset, if there is a downward, then the loss, first it should be transferred to the revaluation reserve account. Previously how much we did, to that extent it will be unutilized. No? Towards that amount we have to utilize. After that, if there is any loss, then it should be transferred to profit and loss account. Okay, fine.